We have Madanagopal Ramu, who's looking after the alternates fund at Sundaram AMC, who's joining us to talk more about the numbers and the market. Madan, afternoon. Thank you so much for your time. First of all, I'd like to understand which side of the debate do you stand for? One is saying mid-cap, small-cap are on steroids, time to be careful. Others are saying that mid-cap, small-caps actually represent the India story well. Numbers are supporting the up move and valuations may have got a bit healthy, but flows are also coming here. So it's not alarming yet. Which side are you on?
Good afternoon, and that's a very interesting question that you are asking. Purely from an earnings growth perspective, mid and small cap is always an attractive space to be, but you need to be very selective. That let me be very clear about it. It's not like you find 100 stocks in mid and small cap which can keep growing on a sustainable basis. There are those 40, 50 stocks which are always looking good, and you need to be careful about valuation also because of the steep rally that mid and small cap segment has seen, particularly driven by flows of in the recent past. Therefore, you need to be very selective. But yes, if you want to play India growth story, large caps do not represent or give the full flavor of it. Mid and small caps do. But I would like to be very cautious and also caution the investor that be selective when it comes to mid and small cap and pay attention to valuation. A lot of momentum is there. Flows are driving the stock prices, and these are danger signals when you are trying to play it on a broader basis. But yes, if you look at purely earnings, mid and small cap are the areas where you will create alpha in the long term. And if you purely look at valuations, then you need to be selective.
Okay, fine. Fair point. But then what's happening in the power space? There's a lot of renewed flows there. Interest appears to be there. Which end of the power value chain would you be most comfortable in? Is it the power financiers where you find value, or legacy power producers, or renewables as power producers? Because capital goods as a power play has been rallying for 1 year and valuations have moved. Which part of the power value chain do you see most risk reward attractive?
Actually speaking, I've tracked the power sector from the time I become analyst. So one thing I just was very disappointed with power sector story in India is the low ROC nature of the business itself, very capital intensive. And from a pricing perspective, you don't really get a good benefit, and therefore the ROC has been very low in the power sector. If you are a power generator, that's something which doesn't fall into our filter at all. Therefore, we have been away. Today, yeah, there is a play of defensive, and therefore power generating companies are also seeing, and power transmission companies are also seeing interest. But I would caution you that these are companies which will not grow beyond 10% from a long-term perspective. Right now, their valuations have been very low, and they have catched it up with the help of flows. But I think long-term growth in power sector, more than 10% to me looks very, very stiff. Therefore, it doesn't fall into our filters of where we look for at least a 15% growth as a minimum benchmark. Second, on the power financiers, the power financiers is a space where, power financial intermediaries. I would like to just understand what is the role that banks cannot play, only that power financiers can play. So to me, that financial intermediation that PFC and REC was doing for a very long period of time is now something which we need to step back and relook at it, whether they really have that moat in the business that they only can lend. See, they're seeing some interest now because there is a lending happening to government as well as lending happening to some specified renewable sector. But how much of this can drive a sustainable growth in these businesses is a point to question. Importantly, the point to notice, like, what is it? Is it really profitable? Because in a space where PSU banks or private banks can lend, but avoiding, then it shows risk. But if they are lending, then the profitability cannot be very high. So this is something which I always keep in mind when I select a financial company. If a space is there where PSU banks can be very active, then an NBFC will find it difficult to always make big money in the long term. So I think that is what I would say, because we don't have any exposures in power generating companies as well as the power financiers. Plus renewables, which you asked me, I think IRRs in renewables are not more than 10-12%. So to really bring it on the table to the equity investors, where the return expectations are closer to say 13, 14 or 15%, I don't think you can really build a big story out of these sectors at this point of time. These are highly competitive space. So we are watchful, but at this point we don't see any big long-term sustainable stories emerging out of power sector.
Point. That's a contra view.
Ticket financiers in the NBFC space or even small financial banks, where you can pay attention to. These are available at reasonable valuation at this point, if not cheap, but they can grow almost like 25% plus compared to the credit growth of India, which could be around say 13-14%. So this is one space, but you need to be very careful about whom you play here. Credit underwriting is an important process, and we pay a lot of attention to these aspects. But we find good opportunities here where people can make money. So this is one story. And second is, I think manufacturing, if you are very selective, you can see opportunities coming in chemical space. Right now, there has been a correction in chemical space. But you have to avoid the basic chemicals because they are spread businesses and very difficult to track. But if you pay attention to some specialty chemicals which have got impacted due to the global destocking that is happening in the agrochemical space, the valuations have corrected quite steeply. So the current correction in the chemical space can offer you 2-3 ideas in our opinion. So that is the other area that you can play, in addition to some of the very say specific capital goods companies where valuations are reasonable. There also you can play. Otherwise, capital goods companies have rallied a lot, and valuations definitely look steep for majority of them. A lot of momentum is driving capital goods companies' performance. It's a consensus buy at this point. So to that extent, I would be very cautious to jump into or even stay invested in some of these names. We don't disagree with the 15% growth in this space, but right now stocks are looking at more than 25% growth expectation. That is definitely looks to me unachievable. But in the manufacturing, there are spots because of the recent correction in some specific segments. There are some opportunities that are coming through. So manufacturing is another theme that we think you have to be very selective here, but you get enough number of opportunity to play. Third is the consumer discretionary. I think consumer discretionary got impacted last year due to inflation noise and all, but we didn't really see too much impact in the consumption. There was impact in the rural consumption, particularly due to inflation, but I think urban consumption continued. So you have to keep in mind that the urban job market kept growing during COVID and continued even after that. And salary increase has also been meaningful. So it has 4-5 stocks in each of these three themes, in addition to the digital space. And then that's how we create a 20 stock portfolio. I think a concentrated approach in mid and small cap does really make sense rather than a diversified portfolio. But all this, I think for the next 6 months, markets can head anywhere because flows are determining the returns today. And the reality will come out only when the flows stop. And that's when the difference between quality business and not so quality business will come out in the market.
Outstanding point which you have made on specialty chemicals and also NBFCs which are tilted towards mid and small, because I did see five-star housing raise their guidance from 30 to 35%. We did see how Utkarsh and even SBFC actually got response in the commentary coming in. Ugro Capital, strong numbers coming in over there. So this is striking me, what you're just telling me. Specialty chemical had a very bad year, 5 years I would say. And even commentary from SRF, UPL, don't seem to be giving any indication that things are changing anytime soon. But I'm not sure, Madan, if you caught the annual report of Bharat Rasayan, another key chemical company which talks about smart recovery expected in the second half onward. So I want to understand this 5-year bad performance. Do you think it's already priced in? Now we should start building in position in at least the top tier chemical names.
Yeah, very good question. I think it's important to differentiate between different chemical companies. That's where I think we need to be very careful about. Say somebody like a Navin Fluorine and PI industry, or even SRF's chemical business. There is a lot of value add that they do than just supplying the basic chemicals. So there, I think India's positioning and these companies' moat is still not changed, and they will continue to do well, in our opinion. There is a temporary period of slowdown due to this agrochemical destocking, but I think it is 2 quarters of impact, in our opinion, because the end user market is still growing and the farmers are still making money globally. Therefore, we don't think the demand will negatively surprise too much. But keeping that away also, companies like Naveen, PI, SRF, all these guys, they have presence across so many other verticals also. And there are verticals where only India can add capacity, and not US or Europe, or even China has not shown interest to add capacity in some of these verticals. Therefore, 2, 3 years down the line, the pricing power will be very steep in those chemicals. So these are very specific calls that we have taken in each of these companies. You were asking about UPL. I think UPL is more like a generic supplier. We are not keen on that name purely because there is no separate moat that I see in that business. But there are other chemical companies where they do a value add, and therefore there is a moat, and those moat is still not broken. It will therefore, in this correction, you have to the investor will do well if they get into those names and stay invested for 2, 3 years when the entire this negative news on destocking and all goes away in a year's time, and then the real growth, because these companies are continuously investing in the projects. Therefore, their earnings momentum will continue. Therefore, investors will do well by making use of the current correction in
Right.
some of the specific names. I'm not referring here to all the chemical companies. I'm being very,
Yes.
very specific about it.
Sure. No, we are not. We're taking some names just one for example purposes. But yes, you're right. What was interesting, which caught my attention, that many companies are cutting guidance for 6, 12 months, but nobody's cutting capex. In fact, SRF is putting as much capex, which is many times their gross block. In fact, other companies too are raising guidance. Aarti, 3, 4 times the capex in the next 3, 4 years. So if they are so negative, why only guidance? You should cut capex also, but that is not happening. So that is something I was observing. But it was very good to have you, Madan, on the show today.